JPMorgan Chase, stock ticker symbol JPM. Looking at banks is pretty new to me, so it took me a long time. There's a lot to go through. We'll try and go through fast. Last time I recorded this took more than an hour, so this is for entertainment purposes only. We're going to look at the 10K, the risks that they kind of foresaw, and before everything happening now was a serious consideration. So we're going to see some of the things that they were scared of. Oversight and scrutiny from regulatory authorities, for sure happening now. Feds making sure all the banks are able to do what they can do, and making sure they increase reserves, and obviously giving a little bit of wiggle room. And they talk about also government agencies. So this is mostly overseas, governments interceding on behalf of clients that they feel like the banks have wronged. That might happen a little bit more. The EU, so Brexit, that's going to make things more fragmented as they have to leave the UK to help serve other parts of the EU. It's going to increase operating expenses, liquidity, leverage, and capital, and just make the whole system more complex. So if you look at the EU, specifically the United Kingdom, they're $42 billion exposure. The rest of the EU, quite a few countries, and that's totally $165 billion. So that's going to be a little bit more expensive to now manage because Brexit and, it's not just one system, it's going to be two. Also, when they talk about the London Interbank Offered Rate, so this benchmark is used to do floating loans. So as the interest rate changes, the amount that you owe the bank for your loan will change as well. So they use things like LIBOR or other things like that. It's going to be discontinued at the end of 2021. And so what's going to happen is a little bit scary because these types of rates like LIBOR, IBOR, they make up $400 trillion worth of transactions and contracts. And so what happens when you're a client and you say, hey, this new rate that you've put instead of LIBOR is worse for me? Well, they might try and sue. So it can make things a little bit complicated, but I'm sure with $400 trillion now, that's not just Chase, that's everyone. People are clearly working on this. Nevertheless, still a risk. In terms of the EU, they're going to have to move to the Germany, Luxembourg, Ireland, and open up shop there. They've already moved employees since 2019. So they're working on it, but obviously that's going to make things more complicated. Now, in terms of political developments and issues, is the US dollar going to be a safe haven currency? A few episodes we mentioned before, yes. During 2008, that's what happened. People thought it wouldn't happen, but people moved into the US dollar. Are there going to be retaliatory countermeasures by other countries? Well, yes, definitely possible with all the tariffs, outstanding debt service, yes. Possible government shutdowns if funding doesn't happen. Yeah, that's for sure possible, although we haven't seen it yet. Market dislocations between countries, economic conditions affecting everyone. Yeah, for sure. Business sentiment, consumer sentiment, that's a problem. Reduced confidence in financial markets. Yeah, inflation and deflation, definitely possible. What you're seeing is banks like the status quo. They like standard things to happen, right? It's going to help them do business. High unemployment doesn't. Health emergencies don't. U.S. and global economies having problems. That's for sure an issue. Unexpected credit events, right? And this is the point, that how do they develop their pricing of financial instruments to include all these crazy things? And that's what they have trouble with. Also, they have losses in their investment portfolio, possibly. That'll constrain the growth of their business. Adverse economic conditions, they look at interest rates, they look at inflation, unemployment, consumer and small business confidence, changes in consumer spending, personal bankruptcies. It's a little bit scary because we're looking at 5 of the 6 of these has serious possibilities of all happening at the same time. Lower negative interest rates, recessionary issues, that's going to also affect the cost to provide these products and services, let alone delinquencies and higher net charge-offs, which means people not paying their loans. And another interesting thing they mentioned, government proposal to allow students to get out of their debt by bankruptcy. That hasn't come up yet. But it's definitely a liberal talking point, so we'll see with the election what that brings. Sudden severe downturn in oil and gas prices. It's amazing, all these things. It's very scary that all these things are really happening. Downturn in financial markets, so those could affect the valuations of client assets, and so even just fees that they give to their clients for managing their assets could lower. Outflows from bank accounts with Chase and unexpected withdrawals, that might force them to sell assets at bad times just to be able to pay these people out of their funds and make sure that they have the liquidity. Now, this one has not happened. And I guess my point is, obviously, I'm cherry picking most of the things that do happen. I'm leaving out these things that haven't happened. So I think it is important to mention that obviously I'm cherry picking, but the point I'm trying to make is there's a number of different things, a number of different scenarios and knock-on effects that are all happening. Lower spending, for example, with their business clients. So, for example, let's say you have rental income and there's a reduce in rental cash flow. Now, people are talking about delays on paying mortgages. We'll see what happens with rental properties. Of course, besides the cash flow, that could depress the value of the properties themselves, which would affect them as clients between them and Chase and what the fees are, as we mentioned. Now, also, if there's extreme market events, of course, they hedge, but extreme market conditions, maybe they can't hedge well enough against those types of things. So what are catastrophes? Well, health emergencies, of course. Now, when we look at how JPMorgan is kind of spread out, we see New York is a major center for JPMorgan, which sadly is being hit. Columbus and Chicago. You're looking at Columbus, we're talking about 13 buildings, and the second largest private employer in the city. Sadly, Columbus, you can see in the center here, is red. It's been hit pretty badly. Chicago in the top left is being hit pretty badly. So nevertheless, they do mention, though, that 3/4 of their branches are open and employees are working from home. An interesting thing here is they mentioned that when there's going to be strife between different countries, even, let's hope not war, but certainly hostilities, when there's enemies of the U.S. or opponents, that will negatively affect JPMorgan. Of course, China is involved. So they luckily only have $19.2 billion exposed with China. Sadly, the whole region, when you're looking at it, it makes up $107.7 billion. So even if they can still do business with Japan, nevertheless, if Japan is negatively affected, they're still exposed there with lending. And so that will affect, their bottom line as well. Interestingly enough, the Chase announced that the China Securities Regulatory Commission approved them, and so they'll be able to do majority-owned securities in China, and they can commence operations. We'll see where that goes exactly, but in theory, if China gets back on track, they'll be able to expand a little bit more in China, which I think is a positive, although, once again, a little tenuous relationship there. Now, when we're looking at Ashley Bacon, he's a chief risk officer since 2013, so he's been in this job for quite a while, 7 years. Sadly, not since 2008. Would be nice if he was there from the previous crash. Of course, he was still with the bank, but just not specifically in this position. The CFO, sadly, has only been there, at least in this specific position, like I said, since May 2019. But I think she has worked at the bank progressively more and more in higher responsibility roles for, 20, 25 years. So that's good. And James Dimon, he's been the president since 2004. He's he's chairman of the board and chief executive officer. He's been there since the crash in a high position, very high position. So I think that's a very positive thing. Now, when we're looking at revenue in general, so you can see $7.5 billion is coming from just fees, for example, from transaction fees. We're looking at mortgage fees. And so that's going to make up a huge chunk. Non-interest revenue, $58 billion is coming just from these types of fees, just from these things that won't be affected by interest rates. And similar amount of income, another $57 billion is from interest. So, once again, the bank seems to be well balanced between fees and interest. I think that's a very positive thing. When we're looking at how they segment the bank, so you can see consumer and community banking on the top here, and then corporate investment banking. So let's look at the first one, consumer and community banking. That's the biggest source of revenue, $55 billion. Corporate investment bank is $38 billion. Between the two, that's about $93 billion, and that makes up a huge, massive chunk of the total, which is $120 billion. Looking at expenses, this revenue is 1.8 times the expenses, and that's better than the previous year, 2017, of 1.76. So, that's good. The revenue is not only growing, but also the distance between expense and revenue is growing. Okay, so now let's look at consumer and community banking. So we're talking about, obviously, consumers and business, but specifically small businesses, I suppose. The type of bank that you and I would presumably use. Lending and deposit-related fees, that's talking about $3.8 billion. Card income is a little bit higher. We're talking about $4.8 billion. And the interest income is $37 billion compared to the $18 billion. So you see that the consumer and community banking they make a lot more of their money from interest-related income. And you can see a big chunk of that, just revenue in general, is coming from home lending, card, merchant services, and auto. And we're going to see credit card is a little bit scary type of income for banks because of, how risky it is. In terms of total assets, you can see, sadly, it's been going down in 2019, whether you use just the last day of the year or even just the average of each year. And you can see that home lending has gone down quite a bit. Credit card has sadly gone up, not as much. And deposits have gone up, which I think is a good thing. Now, if we look at the total net charge-offs, you can see that's kind of standard how much money they're losing per year from the bank, from people not paying their loans, and that's mostly in credit cards. And that's why I was saying that credit cards are important. And when it comes to the reserves, so how much they allow for loan losses, they're focusing once again, mostly that $5.6 billion is specifically credit card of the $8.8 billion. So that's a huge chunk. So it's really key to focus on this credit card debt. Now, when we're looking at the number of branches, you can see it's going down. But luckily, when you're looking at the digital customers, we're going up, maybe not by 10% exactly, but not so far off, which I think is good. And it's also a good sign to see that debit and credit card sales volume is also going up bit by bit. Once again, almost close to 10%. So I think that's a good sign, shows strength in the bank. Now, when we're looking at corporate investment banking, we're talking about bigger, corporations, financial institutions, government and municipal entities. And how do they make money? Mostly from non-interest revenue compared to interest revenue. It's about 3 times more of non-interest. And you can see that the net revenue keeps going up, even if that net interest income has been going down, but the net non-interest revenue, so the fees, have been going up, and that makes up for it. I think that's a good sign, and most of it's from principal transactions. Will those types of things go down? I don't know. That's hard for me to know. But you can see, once again, the fees are where they're making a lot of their money. In terms of the corporate investment bank, how far are they exposed internationally? You can see Asia Pacific, it's only $5 billion. So internationally, compared to North America, very similar amounts. So once again, there's a certain amount of balance there, which I find nice. And I also find it nice that when we're talking about loans, so international loans are about half compared to America. I think North America, maybe I'm biased, but I think they're in a much stronger position. So I kind of like that. And we're looking at commercial banking. So, we have all the different, corporate sizes here, including middle banks, small business and mid-sized corporations, as well as larger corporations. And one thing I noticed was they mentioned an increase of 4% in non-interest revenue, and that is from mergers and acquisitions, growth in lending and deposit-related fees. And so, when there's downturn in the economy, you can assume still that there's going to be mergers and acquisitions, right? Companies are going to be cheap. Other companies are going to buy them. Maybe they need some underwriting to help. And in terms of lending and deposit, I can't imagine these things going away necessarily. Even if they shrink a little bit, they're not going to just disappear. That's important. In terms of consumer exposure to credit, so we're talking about going down from 420 billion to 390 billion. I think that's positive. That's going down. And sadly, when we're looking at the credit card exposure, it's quite a sizable amount. We're talking about 820 billion, and that's going up. Interestingly enough, though, most of it is lending-related commitments. So how much money can you take out on your credit card? And that's, close to 4 times about the amount of credit card loans you can see just above it. So really it's 170 billion, but there's a huge chunk that's possible to grow for that credit card exposure. In total, we're talking about consumer exposure of $1.2 trillion. That's an enormous amount of money. In terms of wholesale, so we're looking at, once again, companies. You can see that the loans we're talking about $540 billion of loans existing. And once again, commitments, we're not talking about 4 times. Luckily, we're just talking about almost doubling the amount that they have committed to lending these companies. But once again, we're talking about $1 trillion of credit. So once again, crazy number, a super amount of a number. It's hard for me to consider. Real estate is the biggest credit exposure. After that, consumer and retail. Consumer and retail, I can see doing a lot worse than real estate. Sadly, people aren't buying real estate, but that also means that there's not necessarily going to be a crash too. So I don't know how to look at that exactly, but consumer and retail I could see being a little bit scarier. Oil and gas, 42 billion, not small, not big. And transportation, I don't know what that means, if that's airlines, cruise liners, or just trucking companies, but nevertheless, much smaller. So whatever it is, obviously less scary. In terms of the multifamily, I just found this interesting. In terms of real estate, 86 billion is apartment buildings, and most of that's specifically in California. So if you think California is going to go through a real estate crash because of all of this, or for whatever reason, something to keep your eye on. Now, nevertheless, they do mention that 91% of this multifamily stuff is investment grade, so it's probably not the biggest deal, but something to keep your eye on if you know more about California. Now, in terms of these lending-related commitments we mentioned, these are maximum possible credit risks. Now, they mention that most of these commitments, they don't expect they'll ever be drawn upon or defaults occurring, right? They don't think that the total contractual amount represents a real credit exposure for them. But however, I think that companies are going to be taking out as much money as they can just because they need to deal with loans that they owe, other institutions, or to help them fund, their expenses through these difficult times. And so I'm not so sure that they're right that, these commitments won't be taken up. What happens if someone has difficult times and they have to keep putting money on their credit card? So it's a little bit scary to me. Now, when we're looking at the allowance for credit card losses, you can see that, credit losses, you can see that credit card and wholesale, so for business, they're very similar, $5.5 billion. Now, interestingly enough, you can see that the net charge-off, so how much are they actually losing, or expect to lose, I should say, from credit cards is, $5 billion compared to only $400 million from wholesale. What's happening? Well, each year they are putting in more provision of loan loss, so for a credit card, they're putting in another $5 billion because they took out $5 billion for that loss. However, for the, the business side of things, or the wholesale side of things, they lost $400 million, they put in $400 million. So as much as the total allowance for credit loss is similar, it seems like there's a lot more of it gets lost in credit card compared to businesses. And you can see the ending balance is pretty similar to what it is now. So they're maintaining it, and it's pretty similar to the year before. So it's not a huge spread, although it's going to have to be dealing with what's going on now. Now, they do mention that there's a 90-day grace period for people and consumers. And what's interesting is, will this just delay people defaulting on their credit card, or will it give people a chance to actually pay this stuff off, right? Are they going to get more and more debt after 90 days and not be able to handle it? I don't know. But what's good for the bank is they have an extra 90 days to deal with this new debt. And so if people run up their credit card debt, the bank has another 3 months before they really have to deal with it, and they can use reserves. They can use the money they're making in the meantime and possibly borrowing in the meantime to help them handle these losses. So that actually is good for both the consumer and the bank, interestingly enough. So in terms of net income, keeps going up year over year. I think that's really positive. But there's all these changes in terms of what's going on. Trading assets, you have almost like a $40 billion swing from 2018 to 2019. Same thing with securities borrowed, quite a bit of a swing. Accrued interest and accounts receivable, it keeps going down, but went from $15 billion 2 years ago to $78 million. And the opposite is true for other assets, got bigger, or I should say worse, more negative. And in terms of trading liabilities, you have constants with 26 billion down, 18 billion up, 14 billion down. So it's a little scary to see these types of swings. Nevertheless, when we see the revenue, just in general, 2008, it was down. Afterwards, it came back. Nevertheless, it was having some trouble until 2016, and then it picked up. Not sure exactly what happened for the 4 years that they were having trouble. They did make some acquisitions after the crash in 2008. Maybe there was some issue incorporating them. You can see operating income took a much bigger hit in 2008. They were obviously trying to get reserves, trying to deal with all the loss and liquidity. But you can see operating income came back up, which I think is really important. And once again, their liabilities spiked in 2008. They were taking out money to help with liquidity, and I think also for mergers and acquisitions. But nevertheless, they got it back down. It's still more than 2006, but it seems a lot more like it's manageable. It doesn't just balloon back up. So I think that's positive. The stock price has been doing pretty well even during 2008. The PEs, the price to earnings ratio, it seems to be on average around the 10. And we're kind of back to that average time. And And why is 10 so much lower than the average of the rest of the S&P 500 or other businesses on the stock market? Well, probably a lot of reasons. One thing, banks are cyclical, so they're not always doing well. Economies go, there's debt cycles or whatever. Economies grow and expand, and then they shrink, and so people aren't willing to pay as much for a bank that's going to be tied to that growing and shrinking cycle. They're also, banks are leveraged, so if things go badly with a bank, it's a bigger movement in terms of the difficulty the bank is going to have to get out of this situation. They're affected, banks are affected by interest rates. I don't know, there's definitely quite a few things that would make someone, let's say, more hesitant to invest in a bank. The positive side, of course, is if they're cyclical and things are going bad right now, well, cyclical things end and things go back, just like you can see with 2008. So, there are some positives. Now, when we look at the stock price and compare it to the dividend yield, so you can see actually important, before we get there, is 2008, you can see the dividend payout, the amount that they're actually paying out per stock, you can see it was cut. That's very possible to happen again. Nevertheless, it was, happened for possibly 2 years or whatever it was, and it came back, maybe not the exact same amount, but it very quickly returned to what it was. And so right now we're at a 4% yield. So even if it does get cut and you don't get your dividend, but if you're willing to hold this for 5-6 years, that's pretty good. 4% is looks like quite high, and it's not the 6% that you can see, in the 2002 or in 1995. But that seems pretty rare. So I don't know if we'll go to 6% if you're looking at a high dividend. I think 4% is still pretty impressive. And of course, their payout seems to be growing pretty steadily, which is a very big positive. Now, when we were talking about those clients drawing down their credit revolver, right, how much they committed to paying businesses. So we're seeing here that they only have $50 billion being taken out. They extended $25 billion for some clients. So to me, that's surprising that, how much they've committed. I believe, if memory serves correct, it was around $400 billion. So we're only talking about 10% of that commitment being actually taken out, which is surprising to me. But it's good to see that, the bank is not being as stressed. Now, when we're looking at debt to income, you can see that households in 2008, they were doing pretty bad with 1.3 debt to income. Whereas, you're looking at corporate, it's been pretty good. It's been around 1.5 or below until recently. It's above 2. So, it's a little bit apples and oranges, but it is good to understand that there's a lot of risk going on. In terms of debit and credit card sales, what's the change? Very interestingly, restaurants are down 50%. I would have thought people were going to restaurants more, ordering in. But nevertheless, no. People presumably are cooking more, I suppose. Travel and entertainment, of course, is down 100% to zero. No one's going traveling. So I guess that makes sense. Supermarkets, wholesale clubs, discount stores, they're doing pretty well. People are spending money. What I found interesting, brick and mortar supermarkets are doing a lot better compared to e-commerce. I thought e-commerce, in fact, might even be doing better than brick and mortar supermarkets. But no, people are going out and they're getting the stuff they need to. In terms of loan growth, you can see that in March, there's a 10% rise. The revolver draws, just in those squares, it was kind of empty on January and February. March, all of a sudden, $55 billion drawn down. So, that's what I would expect. I would expect even more. We're about to see that's not true, though. Deposit growth, interestingly enough, grew by 23%. So that, to me, is surprising as well. Now, we're looking at the reserve build. You can see in the end of 2019, it was only $14 billion. By January, they put another $4 billion because of the Fed asking them to, and then they built it even higher to $25 billion. And that last bit, that $6.8 billion, is presumably specifically everything that's going on right now with the economy and health. And a major part of that is because of credit card once again. So you can see that they're worried about it. Also, oil and gas, another $2.4 billion. They're concerned about that. So once again, good. They're covering and considering all of their areas of exposure. I think that's very proactive, very good. And I'm sure the Fed would be upset if they weren't. Revenue is pretty constant, around $28 billion. It's a little bit of a dip recently, but that's, it's fine. Nevertheless, you can see that their net income is down, right? Usually it's around $8 billion. Now it's around 2.9. Well, that's because they had to build those credit laws. Usually it's 1.5 billion being put away for people defaulting. Now it's all of a sudden 8.2 billion. So that will affect their earnings per share. You can see on the bottom over here, it's usually around $2.5 earnings per share. Now all of a sudden it's 79 cents earnings per share. That's going into provisions for credit loss, and that will probably happen in the next quarter as well. You can see deposits here. It's usually around $1.5 billion. Now all of a sudden it's $1.8 billion, right? That's that 23% increase. I just assume that the people are taking money out of investments or wherever it is, other banks, I have no idea, and putting it into Chase. If there were new customers, I'm sure they would have told us. So I just assume there's people moving their money around, but it's pretty extreme. You can see that they are depositing, another $100 billion with banks around the world. I don't know if that's because of hedging or because I remember seeing somewhere that they had to move a lot of money to Japan to deal for some deal with their clients. I'm not entirely certain, but nevertheless interesting. Debt and equity instruments, they dipped at the end of 2019. Maybe they were taking money out of the stock market, and now they put another $100 billion back into the stock market when things are cheaper. Pretty interesting what people are doing with their money. It's possible they're also doing buying and selling bonds. I don't know. I'm hoping that it's stock because that will be, I think, better for JPMorgan. Now, we're just going to look quickly at the call transcript and just see what they were talking about. They say that there were, going to be headwinds in 2020. It's going to be harder to have revenue compared to 2019. That's to be expected. They mentioned $3.5 billion decrease in non-interest revenue, right? So that's going to be a huge chunk. That's not quite 10% decrease, but, I don't know. That's pretty sizable, right? We said there was about $50 billion of their revenue is from non-interest. They're going to have issues with their asset and wealth management and investment banking fees. $65 billion for, that they'll have to adjust in terms of their expenses because of lower volume and revenue-related expenses. So they're going to have some issues going into the next quarter, of course. Nevertheless, whatever they've seen so far, they think it's small compared to what they'll ultimately have to deal with. In credit cards, they're seeing payment rates go down, but they're saying it's still strong. And they're seeing a slight uptick in late payments for auto. So that's, personally, I think that's interesting. So, once again, credit cards being an issue. Now we're seeing auto also being an issue. They're saying that they did surgical risk management over the last few years to minimize their risk. Hopefully that's true. I don't know what that means, but hopefully that's true. In terms of their economic forecast, this is a little bit scary to me because they're seeing GDP down 25% and unemployment at 10% in the second quarter, whereas other people are seeing it almost twice as bad as, GDP 40% down in the second quarter and unemployment as high as 20%. So they admit that's obviously materially different. So it's a little scary that there's such big swings. They both think there's going to be a recovery in the back half of the year, so I hope so because I'd like to get out of the house. But nevertheless, if that's wrong, that's going to be scary because it means that really no one's seriously considering. I mean, I'm sure they consider that possibility, but they're not seriously considering it. So I'm not a big fan of that. That's, to me, scary. Nevertheless, they say over here, which we mentioned before, that they're going to build reserves in the second quarter. So expect the earnings to be bad. And, I'm sure that's already priced into the stock, which is good. Are they going to have to build earnings in the third quarter? I don't know, very possibly, especially because the 90-day grace period might kick back some of those lower earnings. And so maybe that's, I don't know, are people, putting that into the stock yet? It's very possible. Okay, but something to consider nevertheless. Here they say, well, now I was surprised by this. In the second quarter, they're seeing a pause on revolver draws, so companies aren't taking out more money that they have, that the bank has committed to allowing them to borrow. But they're saying it could just be a pause and it could go down further. They think that there will be people taking out money in the second quarter, but less than the first quarter. And to me, that's surprising. I think that's really positive if it's true, if it's really going to happen. But to me, it's a little bit surprising, so I'm not entirely sure. Now, when we're talking about bridge loans here, now, but also, by the way, it's pretty scary when Jamie Dimon starts off his sentence with, and I would also put in some perspective, we're adults. That's never going to go well. So what are bridge loans? Bridge loans are pretty much if you have a company that's not doing so well and the bank wants to give them some money to allow them to get into, let's say, a better economic position so that they could be a regular client and they could meet all the requirements to be someone that they could, for example, offer these credit revolvers and all these other services and fees. So these banks are willing to lend a hand to a business that's having trouble, hopefully getting them to be a client. Of course, if you're dealing with a business that's having trouble, well, they might go bankrupt. And they mentioned that their bridge loan size is a quarter compared to the financial crisis. That's good. It's only $13 billion. And of course, another positive is that they have no imminent closing deadlines, right? There's, no one has to pay back their money immediately. And so they'll have some time to be able to figure out how to chase back these bridge loans. So hopefully there won't be defaults is the point. Now, they mentioned that in 2008 to 2009, they built their reserves, I don't know if they built the reserves, but nevertheless, they had to get liquidity, and it cost them $47 billion to put things in perspective. So that's interesting. Now, Jamie Dimon does mention, though, that the reserves that they had went from $7 billion to $35 billion down to $14 billion. Is that because they used up the reserves? Well, he makes it sound like they're being they are and maybe were being conservatives, but they're in terms of their reserving. But nevertheless, there's flaws. Makes it sound like it shouldn't have been at $35 billion. They were just being careful. I think that's good. I think it's good for a number of reasons. Obviously, it's protecting themselves. But on the other hand, you can see that if the next earnings per share, let's say, were low, so that $35 billion looks like they're taking it off their balance sheet. Why? Because it's almost like they're saying, hey, we're going to lose this $35 billion. We're putting it aside for loan losses. So it's almost like it's written off. It's not part of the earnings per share. And then when they move it back to earnings per share eventually, either little by little, you can see that will help them, even if the next quarter maybe isn't as good, but now that they're moving some of that money back into the company, right, they're not writing it off as a loss. They're saying, hey, we actually do have this money. So that will obviously help their earnings per share, and so they'll come back presumably much quicker, at least in terms of the earnings per share. I don't know if people will look past that or not, but I found that pretty interesting. They also mentioned this idea of the 90-day grace period. They also, maybe it's just delaying losses. Nevertheless, they're going to be reserving while they can. Now, how do banks make money? Well, one of the ways they make money is by taking your money, right, a deposit savings account. They'll give you a savings rate or interest rate that's pretty low. They'll lend out that same money at a higher interest rate. And, a good proxy for that is the 10-year treasury compared to the 2-year treasury. So 2020, you can see it's low. That means that it might be difficult for them to make money on their interest side of things. You can see usually when it's low, it seems to come back in a few years, except for in 1995. But it's very possible that that's what's going to happen here as well. Now, I did find an article, interestingly enough. They mentioned as the 10-year treasury will rise, so will the bank price in terms of the stock will also rise. When these yields narrow or widen, it can change it can exaggerate these stock prices. And that's the way people seem to look at banks, which is pretty interesting. They do mention that that's not necessarily true in reality, though, because the profitability of banks doesn't necessarily rely solely on interest. We saw this bank especially is pretty well diversified, right? They have half of it in terms of interest, half of it in terms of just revenue from fees. So I think they're kind of spot on, at least as far as JPMorgan goes, and I think that's a really positive point. Now, in terms of insider buying, I found this fascinating, and I really usually don't follow this type of stuff. I just happened to notice it. Stephen Burke, who's a director, he's on the board. He bought $7 million worth of the company in terms of shares at $87, so on the dip. Ashley Bacon, who's the chief risk officer, he actually sold 1.1 million. So it's a little bit conflicting. On one hand, you have Stephen Burke. He's a director. He doesn't necessarily know the day-to-day operations maybe as much as Ashley Bacon does, who's the chief risk officer. So on one hand, it sounds like you might want to trust or look at what Ashley Bacon's doing. On the other hand, Stephen Burke, obviously he's on the board for a reason. He's also on the board, though, of Berkshire Hathaway. He's a close family friend of Warren Buffett. Warren Buffett invests in a lot of banks, including, I'm pretty sure, JPMorgan. And so, you could imagine that Stephen Burke might have had a conversation with Warren Buffett, or at least knows how Warren thinks. And so this might be a very interesting tip of the hat of what Warren Buffett might do or what he would advise someone to do. Now, it's always hard to know, how much money does Stephen Burke have, and maybe this is just a small drop in the bucket for him. I have no idea. He's on a lot of boards quite well to do. And Ashley Bacon, it's hard to tell what's going on here, but I think it is a little scary because we're going to see that a number of people are selling their shares, right? If we look at March 25th and we take a look at James S. Diamond, he's disposing of $20 million worth of shares. Now, interestingly, we're going to see here that it's 220,000 shares. And he also exercised an option on the same day for almost twice that many shares. So obviously this is some sort of bonus or salary that he's making in terms of options, and he's selling, it looks like, half of what he exercised. If we look at Mary Callahan Erdos, assuming I'm pronouncing that right, Chief Executive Officer of Asset and Wealth Management. I'm sorry if I mispronounced your name. She also exercised an option. She disposed half of it for $5 million. So, if I just do a back of the napkin kind of calculation here, we're looking at an $89 value per stock that he was willing to sell. So does he think that it's going to come back? I don't know. He's also only selling half of his position. Well, maybe he's only allowed to sell half of his position. Maybe that's part of the rules. I don't know. But it's definitely interesting and a little scary. You also have, once again, Ashley Bacon again getting exercising options, disposing of half of them. And you have a number of people here you can see, whether it's the Chief Executive Officer of Consumer Lending and Card Services or the Chief Executive Officer of Commercial Banking. You see this kind of pattern that on March 25th, everyone was exercising options and disposing of half of them. So to me, that's a little bit alarming. Now, I also found over here that, you had people selling on an average price of $137 on January 15th. Once again, this Chief Executive Officer of Asset Wealth Management. You see a number of people, the CFO also selling at $137 a few months ago. And if you look at kind of the graph, so it's a little bit confusing to me. It looks like the past year, people, at least at the beginning of the year, also selling off their shares, exercising options, selling them off, compared to a few months or, before that. So I don't know what to make of this. My best guess is people were looking at the current situation of the stock before the crash even and saying it's overpriced, and they were selling it. What are they doing now, selling it at a dip? I don't know. Maybe they're scared that it's going to go further. Maybe this is just how they take their bonus. I'm very confused about this situation. You certainly have someone on the outside buying the stock, and you have a lot of people on the inside disposing of their options, at least half of their options, certainly, and Ashley Bacon even going forward and even selling more. So that's a little scary, to be honest. That bothers me. Nevertheless, we have a pretty high stock price, but nevertheless, it took a 30% cut, and the PE ratio is kind of down to the average of 10. So it's a really difficult choice here of how to look at JPMorgan. But like I said, banks are cyclical. I'm a little nervous about all these people insider, selling their positions. If you know how to look at this, is this normal? Let me know if you have any experience with this type of thing. Because you also have this Stephen Burke, who's presumably not bothered by this and might have also expert advice, taking a sizable position in the company. So, from my perspective, just the idea that everything could turn around, maybe not in a V-shaped as everyone's talking about, but that these things are cyclical and these things do turn around. Banks do come back. You see in 2008, this did come back. It might be a very valuable time to start investing. Would I invest everything? Once again, entertainment purposes, but would I invest everything? No. Once again, because the second quarter they're going to reserve. They might only have seen the tip of the iceberg in terms of issues going on. So it's a little bit scary with banks. Nevertheless, like I said, they're cyclical. The government, the Fed, they're going to try and do everything they can to protect banks, especially one as big as JPMorgan. Hopefully it doesn't dilute your shares, right? If JPMorgan has to take money from the government, just because the company is protected, well, you as a share owner might be negatively affected, right? Because the government might take shares and increase the pool of shares, and so your earnings per your share would diminish. And so you would lose some value, sadly. But I think that the bank is in a much better position. You see a number of things. They have a higher reserve. They have a smaller bridge loan. It seems like they're managing risk quite a bit. So I think there's a lot of positives going on for JPMorgan. That's why I'm saying I would start investing. Would I invest my whole stake that I wanted to in JPMorgan? No. I would be doing it kind of slowly, especially as we're moving towards the second quarter. Because once again, I assume that the bank stock is not going to recover that quickly, right? You can see in 2008, it didn't just all of a sudden come back. It dipped, and it dipped a little bit further, and then it came back a little bit. It's not all of a sudden. I don't have to get in and out all of a sudden. So that's kind of my perspective. JP Morgan seems really in a good position. The fact that they have these balance between interest and non-interest in terms of fees, I think that's a really positive thing. They'll obviously both be affected negatively, but in different ways, different amounts. Like I said, it's a certain amount of balance, and I think that's really positive. So that's kind of my perspective. I'd love to hear what you're kind of thinking, and I am going to start looking at other banks. So once I can kind of compare the balance sheets and everything going on between other banks, I think I'll have a better sense. I think banks are pretty interesting play right now as that area of the market is having difficulty, but tread carefully.